remember in our previous class, we were talking about the accounting, introduction for the accounting. We talk about what does financial accounting mean. We talk about types of accounting. We talk about the main financial statements which we need to report end of our financial period. And we talk about type of businesses, and we mentioned that our report or our study in the financial accounting for this class, it's more concerning about report for the what we call it sole trader. So let's start with a new topic for today, which is the key accounting concepts and principles. Today we're going to talk about the key accounting principles and concepts. Which one of it? We're going to talk about those concepts, which are objectivity, historical cost, money measurement, going concern, separate entity, realization, dual aspect, accrual, time interval, and stable money. Those are the 10 concepts which we're going to discuss during our class today with other topics also. First, we're going to start with the objectivity. Yes, objectivity, it means can be measured. Thank you. So objectivity, it means it's quantifiable, which means can be measured, which is opposite of subjectivity. Subjectivity, it means different people, they will think in different way about it. I will give you an example. This is a 5 ringgit, okay? So each one of us, when see this one, he knows that this one is a 5 ringgit. Okay? This is, if I give you anyone see or anyone want to record, they know that it's 5 ringgit. So this one is objective, can be measured. But let's say I want to describe this cup. For me, I like this cup because the color of the cup, the design, having the letter, the first name of mine, the first letter of my name, the star, the black here, the hand, I like it. Okay, but maybe Yelan, maybe other friend, they don't like it. So as you notice that we are a group of people, some people they like it, like Lina consider it cool. I like the color, but Yelan doesn't like it. So this means that whether this cup is nice or no, is beautiful or no, it's very subjective. I will have different opinion than other. So this is a difference between objective, that this one, or the objectivity, it's quantifiable. All of us, we agree that this one is what? Is a 5 ringgit. But not all of us will agree that this cup is nice. So this is the difference between objectivity and subjectivity. So the first concept is objectivity, which means it needs to be quantifiable. So objective means it's quantifiable. Since can be measured, it means chances are it would be more agreeable to different parties. Like we are here different parties. Each one of us will still say this one is a 5 ringgit. No one will say is a 10 ringgit. Okay? So this one is objective because we different parties, we agree on it. So the objectivity concept, it means it's quantifiable, and as it can be measured, so there is high chance to be agreeable among all people, which is opposite of being subjective, like talent of the stuff, like the beauty of the cup, if you remember, how whether the cup is nice or not. Talent of the stuff, maybe I will consider certain stuff is talented, but another person, they will say no, their skills is okay, but he's not talented. So this thing is subjective. So the first concept in financial accounting is we only rely on, or we deal with only objective items, which means only those items which are quantifiable, which can be measured. This is the first thing. Second concept, historical cost concept. It means that all assets must be recorded at the original cost. First, you'll ask me, Miss, what does assets mean? I will tell you are the items which the company owns. Let's say Manipal is a company. So this company, they own the building, they own the machines in the lab, they own the computers in the library, they own the furniture, they own buses. So all of those called assets, okay? So how to record this asset, or what the amount of money we need to record this asset with, is the historical cost, which is the amount of money we paid to own that asset in the beginning. Let's say Manipal, MIU, they bought their passes 5 years ago. So they need to report those passes by the amount of money they paid that time, okay? Not the current price, because maybe they bought the pass 100,000, let's say, or 200,000 5 years back. But now the current price, it's maybe 100,000 only. So here, it will be, we cannot report the current market price. We need to report the historical cost. But to just consider that this pass, the price is decreasing because of usage, we will do another way, which we call it depreciation. We're going to explain it later. So again, let me repeat. The historical cost means that all assets must be recorded at the time, at the original cost, and not the asset's current market value. So all the assets need to be recorded in its original cost, not in the market value. Historical cost refers to the price or the actual cost we paid for the first place, the amount of money we paid in the beginning to own the asset. Why we use the historical cost? Because it's reliable and objective, while the market value, it's not stable and not reliable. Maybe today I go and ask that if I want to sell this pass, how much? Someone said I will pay 70,000. Tomorrow I go that someone said 65,000. After a month, they start again doing the travel among the states and they need big buses. So someone said 100,000. So these things are not reliable. We cannot rely on. So for that reason, the historical cost concept believes that, or stipulates that, we have to record our assets based on its historical cost, okay, which is the amount of money we pay in the beginning to own that asset. So now we get two concepts. First concept is objectivity concept, which means should be quantifiable. Second, historical cost concept, which means we need to record the asset based on its historical cost. Let's move to another concept. Money measurement concept. Money measurement concept is our third concept of today's class, which means based from the name, money measurement. So this concept believes that we can only record those transactions which can be reflected by money. Those which can be reflected by money or measured by money, we cannot record it in our accounting books. So money measurement concept states that only activities that can be measured in terms of money should be recorded in the accounting books. Only transaction or only activities that can be measured by money should be recorded in the accounting books. Only those can be measured by money. Those can't be measured by money, we cannot record in our accounting books. Based on that, we can understand that our accounting books are not reflecting everything to us. As example, the accounting books is not going to reflect to us whether our management is good or not. Someone will say, but if the management is good, so we're going to get good profit. I know. Profit is a different story. But maybe the management is able to gain profit, but is not good with the staff, dealing with the staff. This is one example. Maybe the staff among themselves, the work environment is not suitable, while still they are working there because they don't want to lose anything from their salary, but the work environment is not good. So anything which cannot be reflected by money cannot be recorded in our accounting book. So accounting is only concerned with those facts which can be measured in monetary terms, and the money value of the transaction is agreeable to most people. Common unit of measurement. Then accounting can never tell you everything about a business. For example, accounting doesn't show the following: whether the firm has good or bad managers, that there are serious problems with the workforce, that a rival product is about to take away many of our best customers. All of this cannot be reflected or shown in our accounting book because our accounting book only can contain transaction which can be measured by money. So if we repeat, what are the three concepts we learned till now? The first is the objectivity concept, which means the item or the things, transaction should be quantifiable. Second, we talk about the historical cost, that we need to present our assets based on its historical cost, which is the amount of money we pay in the beginning to own the asset. Third, it's money measurement concept, that only those transactions which can be reflected by money can be recorded in our accounting books. Concept number 4 is going concern. As our friends mentioned here, the going concern concept, this one is assumption that the accountant, when he is doing the final accounts, he should keep in his mind that the business is continuing for foreseeable future, which means that our business is continuing. What does it mean? Yes, we know it's continuing. Okay, let's take it in another way. You are preparing your financial statements end of the year, and you are concerning about what to do or whether our business is continuing or not. If you know the business is going to close after 1 or 2 months, so most probably you will start looking for someone to buy the assets. So you want to get the real price, the market price of your assets. Sure, you're going to start look for your customers. Do they pay back their credit? You start contact with your suppliers. Do you pay them back their money? And so on. So you are closing most of your business. But in the normal case, your business is continuing, but you need, because now you will take also another concept, it's called time interval. You will need as accountant to close your accounts end of each year and prepare financial statements, okay? Because normally accounts we close it end of the year. So you need to do that. Closing your accounts end of the year, it doesn't mean at all that you are closing your business. No. It means that you are just closing the account in a certain date and starting again the second day. The aim of it is just to see how your business is going on. So as example, you as a student, end of the semester, you do exam and you get the exam result. Doing that exam, while it's a final exam, it doesn't mean you finish your study. No, it means a period of your study finished and you are continuing, okay, for second semester, third semester, and so on. Same for the business. The business, when doing their financial statements, they are not closing their business. They are just reporting for a certain period, and they're gonna to continue later. Okay, they're gonna to continue second day and continue, and the business is still continuing, is not closing. So that's what we call it going concern, which means when the person or the company or the accountant, let's say to be more specified, when the accountant reporting the final accounts, he needs to keep into consideration the business is continuing for foreseeable future. So it's not closing the account. So going concern assumption states that an accountant is entitled to work out the final accounts of a business on the basis that the business will continue for the foreseeable future. In other words, that is a going concern. This going concern is also connected to the historical cost. Do you remember when we talk about historical cost, we mentioned that we need to report our asset based on the historical cost. Why? Because we are not going to sell the asset. So the market price for the asset now doesn't make sense for us. So those two concepts are connected to each other, which is the historical cost and the going concern. Why we report our asset based on the historical cost? Because our business is continuing, we are not closing, so we need to proceed with that. Let's continue. We have the separate entity concept. Separate entity concept, it says that the business and the owner of the business are two different things. They are not the same. Okay, what does it mean? It means the expenses of the business we recorded in the business document or in the business books, but the expenses of the owner we don't record. The revenue of the business we record, but the revenue of the owner we don't record. You will tell me, but even if it's sole trader, I will tell you yes, even if it's a sole trader. So the business and the owner are two separate entities, are two different entities. The accounts which are managing the relation between the business and the owner, we have capital account and we have drawing account. Because when the business is owned by one person, in many cases, he will spend something or he will put some money daily or maybe from time to time with the business. So how to manage that? Example, let's say I'm a business owner and I go to IKEA to buy some stuff or some furniture for my home. And I noticed that I need some also furniture for the office, so I order all one shot. And I request from them to send the bill or send the invoice to the shop or to my company. When the invoice comes to the company, so accountant requested, he paid the amount of money, but how he will record? The furniture which are for the business or for the company itself got to be recorded as furniture. But the furniture which are related to my home, they're going to be recorded as drawing. So the first account managing the relation between the company and the owner called drawing, which is when the owner withdraw money from the business for his own use. Second account, we call it capital. This is when the owner puts money in the business. So again, we need to keep in our mind what we call it the separate entity concept, which is the owner is separate than his business, is different than his business, even if it was like what we call it, sole trader, still we need to have different, okay? So what are the two accounts managing the relation between owner and business? First account is which is drawing. This account, it means they are withdrawing, the owner withdrawing money from the business. Second account is a capital, when the owner puts money in the business. So the separate entity concept, according to the separate entity concept, the business entity is seen as a separate entity distinct from the owners. The accounting records are kept for the transactions entered by the business entity and not the transaction related to the owner. Same for withdrawing. Owner transaction that affect accounting in two accounts, new capital and drawing. Examples: insurance premiums for the owner's kid education should be excluded from the expense of the business, even under the sole proprietorship. The owner's house should not be included in the asset account of the business. Rental received by the owner of the renting out of his own apartment should not be included as a business revenue. So anything related to the things where the owner have, let's say, revenue from renting out his own stuff, and this one cannot be considered as a revenue for the business. It's only for the owner. And same also when we pay something for the owner, we don't consider it for the business. So let's continue. So till now, we get what concepts we have learned till now. We learn the objectivity, the historical cost, the money measurement, the going concern, and the separate entity. Let's continue with the concepts. We reach to the realization concept. We reach to realization concept. The realization concept, what does it mean? It talks about when we realize the revenue. What does it mean? I will ask you a question. Let's say you are sitting in a shop and one customer, you are selling, let's say, mobile phones, okay? One customer enter and start checking, asking you, okay, what this mobile phone do? How is the camera? Then he check another phone. How is the selfie? It's very good. Okay, I will come later. And the customer left. Does that mean that the customer decided to buy and you can consider you get revenue? I will give you another scenario. You are still in the same shop for mobile phones, and one of your regular customer, he own a company, and from time to time he come to take some mobile phone from you and he pay you later. You have a contract with him. He come to your shop. He said, I want these two phones. I will take it now and kindly send the invoice to my office. Like this, you will consider a revenue or no? In the first case, the customer was having no obligation to pay. He said, I will come back. Then if he didn't come back, there is no obligation or nothing confirmed that he's going to pay. In the second case, the customer, he has obligation to pay because he's your regular customer and you already have agreement with him that he can pay on credit. He can buy on credit and have a credit line. So based on that, in the first case, you cannot recognize the revenue. In the second case, you do. So realization concept, it's one of the pertinent issues in financial accounting is when to take credit of revenue. To be consistent with the prudence concept, which we're going to discuss it later, in general, profit is taken or realized only when the customer incurs liability for them. Only when the customer incurs liability for them, then we can take the liability, we can, take the realization of the, we can realize the revenue. If you remember in our second scenario, the customer take liability of paying by he saying, send the invoice to my office, okay? A credit line with that customer, so it's okay. He got to sign a letter for us. We will send the invoice later. They will pay us, so then we can realize the revenue in that time. The dual aspect concept. Dual aspect concept saying any transaction happen affecting two sides or two types. What does it mean? The dual aspect concept states that there are two aspects of accounting. One represented by the assets, which means the things the company owns. The other is represented by claims against this asset, which is what the company owes to owners and others. Again, the dual aspect concept is stating that two aspects of accounting. We have two aspects of accounting. First aspect is the assets, which is what we own, what the company owns. The opposite aspect or the other aspect is the claims against these assets, which means what the company owes to others. When we say others, means owners and others. So how that thing is represented in what we call it accounting equation, and the accounting saying thus the concept stipulates that the two aspects are equal, should be always equal to each others. So dual aspect concept is going to be like this: assets equals to owner's equity plus liabilities. This is the first aspect. This is the second aspect, which is the claims against the assets. So again, the dual aspect concept says accounting has two aspects. First, assets, which is what we own, we as a business, as a company, what the company owns. Second, the second aspect is the claims against the first one, the claims against the assets. So how this one is represented is represented in what we call it the accounting equation, which is assets, this is the first aspect, equals to owner's equity plus liabilities, which are the claims against the first aspect. So, as we mentioned, the dual aspect concept says that accounting has two aspects. First aspect is the assets, which are what the company owns. Second aspect is including the claims against these assets, and said that those two aspects should be equal to each others. And that's what we call it the accounting equation, which is assets equals to liabilities plus owner's equity. So here you will ask, what does asset mean? What does liability mean? What does owner's equity mean? I already explained assets, and I said assets are what we own, we as a company or as a business. So assets, what the company owns. The claims against those assets can be either claim or what we call it, what the company owes to owner, which we call it owner's equity, or what the company owes to the others, which we call it liabilities. So the accounting equation has those three items: assets, what the company owns, owner's equity, what the company owes to the owner, liabilities, what the company owes to others. And the accounting equation says assets should always equal to liabilities plus owner's equity. If in any single time in your business this equation was not correct, it means you have mistakes in your accounting records. But being correct, it doesn't mean at all that you don't have mistakes. Again, in any single time in your accounting, this equation was not correct, which means your asset was not equal to your liabilities and owner's equity. It means you have mistakes in your accounting records. But let's say if you don't have, if your accounting equation is correct, it doesn't mean that you don't have mistakes. You may still have mistakes, but are not showing in the accounting equation. Okay, so the dual aspect concept says that accounting or everything in the business, we have two aspects: assets and claims against those assets. Assets is what the company owns. The claims against those assets have two categories. First category is claims to the owner, which is what we owe to the owner. We call it owner's equity. Second, what we owe to others, we call it liabilities. So those two aspects should be equal to each other. This is what we call it the accounting equation. So assets should equal to liabilities plus owner's equity. So that's what we call it the dual aspect concept. Also under it, the assets are divided also in two categories, same as liabilities are divided into two categories. So assets are divided to current and non-current assets. Liabilities are divided to current and non-current liabilities. Later we're gonna discuss about it. Now we talk about the accrual basis. The accrual basis, what does it mean? Actually, in accounting, we have two bases. We have the cash basis and the accrual basis. Cash basis, goes as only when we pay cash and receive cash, we record the transaction. Example, only when we pay for the electricity bill, we're gonna to recognize the electricity bill. Only when we pay the cash for the water bill, like, or even transfer online, only when we pay, there is cash movement, we recognize a transaction. This is the cash aspect. And this is a cash basis. The accrual basis says that when the transaction takes place, we need to recognize it. When the expenses is occurred, when the revenue it happened, we need to recognize it, whether we receive the cash or no. Let's say, all of us, we know the electricity bill comes end of each month. Let's say electricity bill of January will come in February. But it doesn't mean we don't recognize there is electricity bill for January. We need to recognize it even if we didn't pay it yet. So the accrual basis concept holds that the revenue we earn and expenses we bear are recognized at the time they take place. For revenue and expenses, they are recognized at the time they take place and not at the time they are actually paid for, which may be several months later. So example, you like a customer, he said he will pay you later. You still recognize a transaction and you record it, even if he pay you later, similar with the supplier. So based on this basis, which is accrual basis, revenues are recognized when they are earned and expenses are recognized when they are incurred. Again, revenues are recognized when they earn and expenses are recognized when they are incurred. Okay, this one when they earn and this one when they are incurred. So the difference between total revenues and total expenses considered as the net income of the period of the month or the year. Again, the accrual basis, as I mentioned, accounting, we have two bases. We have cash basis and we have the accrual basis. The accrual basis, it says that we need to recognize the revenue when is earned and expenses when are incurred. While the cash basis, he recognizes the revenue and expenses only when the cash being paid or received. Okay, so those are the difference between those two bases. In accounting, normally we use the accrual basis because it's matching with the rest of the concepts. Example, we have the matching concept. We're going to talk about it later, which says to find the income of the period, we need to match between the expenses of that period and the revenue of that period. We need to match between them. Let's say, if you want to know how much you save in this month, so what you will put? You will put your salary of this month and you will deduct your expenses of this month only. So like this, you will know that how much you are saving per month. Let's say you did some travel and that bill you will pay for next month, you should still deduct this money from this month to do the matching to know how much the cost of life was for the current period. So again, the accrual basis is related to recognizing the revenue and the expenses. And we mentioned the revenue is going to be recognized when it's earned and the expenses is going to be recognized when they are incurred. Okay, which is different than the cash basis. And this type of this basis, accrual basis, is it's very connected and related to the matching concept, which we said you have to match the expenses. You have to match the revenue with the expenses incurred to earn this revenue. You have to match the revenue with the expenses incurred to earn this revenue. Example, year-end December, sales in January and paid in March. Do we include? No. Year-end December, we have sales in November, but they're going to be paid in February next year. Do we include? Yes, because it's related to this year. So revenue was earned when we sold the goods, and it must be counted as revenue for this year when we do the final accounts, which is in December. Okay? Profits is the excess of the revenue and over expenses. If you remember, we said we have to consider, we have to recognize the revenue when it's earned and the expenses when they are incurred. So the revenue or the profit is the excess of the revenue against the expenses. I earn 1,000, I spend 900, my profit is 100. I earn 1,000, I spend 1,100, my loss is 100 because my expenses exceed my income. So expenses also, as we mentioned, these spaces, it's also related to what we call it the matching concept, because we need to recognize the revenue when it's earned and the expenses when they are incurred. So therefore, to get the accurate profit figure, we have to compare the revenues earned with expenses incurred related to the same to get that revenue. So this is what we call it the matching concept. Let's continue. We have another concept called time interval concept. If you remember, when we were talking about the going concern concept, we said end of the financial period, we are doing our final accounts. But it doesn't mean that we are closing our business, we are still continuing. And we mentioned why we do that just for reporting matter and see how our business is going on. Similar as when you as a student, when you do your final exam each year. So it doesn't mean that you are finishing your study. It's kind of the interval, like from first semester to second semester, you do that. So the time interval concept says when an accountant prepares a final accounts of the business, they are prepared as regular interval. And this period, the period it covers, is known as accounting period, which is commonly a year. Hence, the term is known as financial year. So it's commonly a year, the time period, and called financial year or accounting period. Some businesses, their accounting period, it's not a year. Some of them, it's less or more. It depends on the business. But the rule of thumb, or most of known, it's a year starting from 1st January, ending to 31st of December. Okay? So again, the accounting period, mostly it's a year starting from 1st January, ending in 31st of December. And this is this is the time interval. When we are preparing the financial statements, we need to prepare from a date to date. So prepare from 1st January to 31st of December. So every transaction happened during this period is going to be reported in those statements. We call it time interval concept. We said the time interval concept doesn't mean the business is closing. It means we are just separating from one accounting period to another accounting period, just to know how is our business is processing and how everything is going on, whether we are gaining profit or not gaining profit, and whether we need to do some modification in our processes. Another concept called stable money concept. This concept concerns about that in accounting, we don't consider the fluctuation in the currency prices. Let's say all of us, we know that most of the currencies, they go against the US dollar. So let's say the price of ringgit in a certain time of the month was 4.1. In the end of the financial accounting period, the accounting period, it was, let's say, 4.5. So we are reporting our accounts in ringgit. So we are not considering the changes in or the fluctuation of the account of the currency prices. We do believe the currency is stable. Even in the most fluctuated countries in their prices of the currency, we still believe as accounting that the currency is stable. We may do some other declaration if we have a lot of cash and our prices or our currency prices are not stable. We may do some extra declaration, but as recording in our accounts, we need to follow only the stable money measurement, which is we don't take into consideration the changes in or the fluctuation in the currency prices. So those are all our concepts, which we put it in the first slide, which is, if you remember, we talk about objectivity, which we mentioned is opposite of subjectivity. Objectivity means quantifiable. Historical cost, which is we need to record our assets based on its historical cost, which is the amount of money we pay in the beginning. Money measurement, which means that the money, only the transaction can be measured by money can be recorded. Going concern, which says that the going concern, which is says that our business is continuing, we are not closing. This is this assumption which you need to keep in mind while we are preparing our financial statements. Separate entity, which means that the ownership between, or what we call a separate entity, there is difference between the owner and the business. We have realization concept, which is when we need to realize our revenue. We talk about the dual aspect, which we said there's two aspects. First is assets, second are the claims against those assets. And the claims against those assets are owner's equity and liabilities. We talk about the accrual basis, which is the revenue recognized when it's earned and the expenses when they are incurred, not when the cash transferred. Time interval, we divide the life of the company to time periods to prepare our statements, and we mentioned is matching with the going concern. And we talk about the matching concept also. The stable money, we said we are only taking into consideration that our money or our currency is stable. We don't consider the fluctuation in the currency. Let's continue. We reached to, okay. Now we're going to talk about the underlying assumptions. Okay, underlying assumptions. Underlying assumptions are the accounting principles and concepts that business entities are assumed to apply in preparing and presenting their financial statements. These underlying assumptions are going concern and accrual basis. So when we are preparing our statements, those two things we should always keep in our mind. They are part of the concepts, but also we have to keep those assumptions always in our mind. After we finish the assumptions and concept, we have 4 overriding concepts. What does it mean overriding? If they've been conflicted with any of the previous concepts, those concepts, they're going to be the one which we need to follow. Again, we have the overriding concept. The term overriding means that these concepts are so important that even that they are in conflict with the basic concept, this overriding concept shall overrule the basic concept. Of course, they don't contradict the basic concept, then both are acceptable. What are the overriding concepts? We have 4 overriding concepts: materiality, burdens, consistency, substance over form. I'm going to explain one by one. Again, we have overriding concepts. What are those? Materiality, burdens, consistency, substance over form. What does materiality mean? Do you remember when I was talking about historical cost, our friend Dylan mentioned that even if we have like pen or paper, is gonna also be recorded by historical cost. I told him it depends if this stationery it's material for the company, which means if we report it gonna to affect in the position or how we think about the position of the company. So materiality, an item is said to be material if it's significantly important to affect our judgment. We consider the item is material if it's significantly important to affect our judgment of the true position of the firm. In other words, any misstatement which affects the decision of a reasonable user of the statement is deemed to be material. So as we mentioned, stationery for Apple is not material because it's not going to affect how we look to the position of the company. But if we have very small printing shop, they count pen by pen and box of paper by box of paper because this is their own capital. This is the very most material product for them. And this is their main product in the warehouse. And missing some of the boxes maybe affect on the position of the company, whether the company is gaining profit or loss. Okay? So this is first concept, which is a materiality. We said when is the item considered material when affect the judgment of about the company. Example: petty cash is considered as cash in hand. In some companies, we have what we call it petty cash, which is amount of money they give each month to cover some expenses. Let's say buy tea, buy coffee, buy some stationery, these simple things. So this one we don't report the changes per details. Yes, we need to record, but it's different dealing comparing to the big cash we have, like when we pay salaries and so on. A business may well decide that all items under 100 should be treated as expenses in the period. Example, let's say the company here, they bought rubbish bin for all the offices. If you count them, there are almost 55 pieces. The company will decide those rubbish bin will consider expenses this year. We are not gonna, while this rubbish bin we may use for 5 years, 10 years, but we are not going to consider it as an asset. We will consider it as an expense because the value of it is very cheap and is not going to affect the position of the company. Then overriding concept called burdens, which is conservatism. Conservatism is a burdens concept, which is saying that we have to be not to be worried. We need to be cautious and play safe. In other words, you don't take profit unless you are pretty sure of earning it, but you must write off loss even if you are not sure in incurring it. Example, if your company goes into case in the courtroom, okay, courthouse. So there is someone raise a case against your company and you go to the courthouse, end of the year, you are feeling that you are losing this case. There is a huge possibility to lose it. So you need to deduct some money of your revenue this year just to manage the loss may happen later. But let's say you are in the courtroom and it shows that you are gonna to gain very huge amount of money from this case. You cannot recognize that revenue because based on the burdens concept. Because it's not yet happened, it still is just like guessing. But you will tell me, so Miss, also the loss not yet happened and is still guessing. Yes, but we need to be cautious. Why? Because maybe the loss happened next year. And then we need to cover it from the revenue of next year, so it will be big burdens on us later. So let's be prepared for it. As all of you do some saving. So you do the saving for possible things bad to happen later, right? But you don't say, okay, next month I'm going to earn this amount of money, so let me spend it from now. You don't do that. So that's what we call it the burdens concept. And I give you the example of the courtroom. Consistency is one of our overriding concepts, which is very important. We have consistency says because we have sometimes different way of dealing with transactions. So we need to be consistent. Example, taking depreciation for some of our assets. Depreciation, I'm going to explain it later, but it's kind of money we deduct each year to recover the asset later. So if I have a machine, I'm taking depreciation for it each year, and I start to count it as 10%. So I have always to take same amount of money. Or I use a specific method for that. Also later you will notice we have a lot of methods for calculating depreciation. So we use a specific method. You have to continue using same method later, okay? So you cannot change your accounting method from year to year unless if it's very important to do, then you can proceed with that. Okay, and you have to justify why you want to do that. So that's what you need to keep, the consistency. As we mentioned, it's you need to apply same accounting method you apply in 1 year and the rest of the years. Substance is over form. Transaction and other events should be accounted for and presented in accordance with their substance and financial reality, not the legal form. Example, sometimes we have some stocks not yet to be recorded under our name, but we can use it. So we can go sell it and can consider as our asset. So this is what we call it substance over form. This means that where the legal form of a transaction differs from the real substance, accounting should show the transaction in accordance with its real substance. And I'm going to give you an example. If a stock was bought on credit, the stock was bought on credit, so not yet to be we own it in the official things, okay? From the legal point of view, the stock doesn't belong to the business until the price has been paid for. However, from economic point of view, the stock can be sold, can be used. So based on that, the stock can be considered as our own things, as our assets, okay? So that, on general, what we can call it the overriding concepts, the 4 overriding concepts, and we talk about the aspects in the beginning and the concepts. That what we can say, it's all the topics we can just in play class.